17 up on the Nifty right now, so things are up, but they're off the day's high. Rohit Srivastava, fund manager at Sharekhan, is joining us right now. Rohit, thanks very much for coming in. You know, the market found support at the 200-day and also at that round 6,000 number a couple of times, right? There were tests, but the market pulled back each time. That's what has happened over the last 4 or 5 days now. And people were, yesterday morning especially, people were saying, well, that indicates formation of some kind of bottom. And then you had that sharp 70-point fall in 10 minutes flat between 10:20 and 10:30 yesterday morning. And I think people are now a little more skeptical, unsure. Where do you stand? Do you think the 6,000 and the 200-day, which is around that, are solid basis or not really?
I think it's a bit early to really call a bottom. 6,000 is holding out probably because there was a lot of option writing at the 6,000 level as this series started last week. The highest open interest has been there, so it's acting as some kind of support. But if we just look at the charts in general, and if you see the pattern of trading by FIs, you actually see a huge reduction in positions from where they were probably in October. They're almost down to zero as far as the long side is concerned. In fact, they have over 6.5 lakh puts open in the market. So now that's a clear change in stance net from the long to the short side. And our sense is that apart from 2-3 days of bounce back that we've seen, the overall trend still remains down. 6,100 should be the key resistance level, above which we are not seeing the market go, and we should eventually head to below 5,800.
You know, I was looking at the options data. There's about $2 billion worth of open interest as far as index puts go. Roughly. I mean, the data I have, frankly, is as of day before yesterday's close. Last time we had this kind of build-up, that was, I think, in June 2013, maybe a little before that. And then I remember markets fell 7-8%. We are already down from 6,350, 6,400 to 6,000. So you think, you know, this time it could be different, and majority of the fall is behind us. Back then the currency also fell quite a bit, but the currency has been relatively steady this time around. What's your view?
Yeah, see, the currency usually does not participate in the first leg of a market sell-off. Like we discussed last time, my sense is that the market has stopped for the year, so I expect most of 2014 to be a bearish market, if not a range-bound market, but more on the bearish side, and probably see more downside. You might have a lot of wild moves on the up and down trends, but you'll get big moves either way. So the currency, even last year when you topped in January, you actually saw the markets fall, but the USD INR remained in a very narrow range between 54, 56 before it really moved towards the 60 mark only after May. So that was like almost 3 to 4 months late. And then I actually looked back, and that trend has repeated itself most of the time since 2008. Even in 2008, when you saw a 30% decline in the market from the 6,300 level right at the top, the USD INR barely moved up by a rupee or two. So this has been the case. 2011 again, a market topped close to 6,300 and was falling for almost 8 months, and the USD INR just remained at 44, 45 for most of those 8 months, moving just a few rupees up and down. And actually the move came only after August of 2011. So we've seen this trend, and probably so the USD INR would only reflect the market weakness at a very advanced stage of weakness. I think we've just seen the first sell-off from 6,300, 6,400 after the market stopped this year. And the two might only correlate strongly at a much later point of time, but as far as the Nifty itself is concerned, I think even for the immediate move as far as February is concerned, or the rest of the month, I think there's still more downside left.
You're saying we're going to 5,800 first on the
I'm saying
index,
it's
50.
Yes, I'm saying it's going to 5,800 or lower first before you see any upside, and upside should be capped at 6,100.
Right. So you sell here. You sell around here.
That's right.
And the currency will follow shortly.
Yes, the currency should eventually catch up as, I mean, it's lagged most of the emerging market basket if you just look at currencies as a whole around the world. Most of the last 4 months, I think India has lagged the world markets. If you look at Brazil, it topped in October and has been falling for 4 months consecutively. If you go and look at Singapore, it's already fallen this week below where the Nifty was at 5100 in August. So you have various Asian and emerging markets which have been falling off the cliff. Similar with emerging currencies. The Indian stock market held up a little longer, and the currencies also held down a little longer because of probably a lot of measures that were taken in between. But I think we're just joining a trend which is now getting more and more global rather than just a local affair.
Right. So what's the basic hypothesis, Rohit, that you're working with? Are you, because if you look at US Treasury yields, they are down year to date. Now you can say that's counterintuitive, that's technical, etc., etc. But 2013 sell-off in currencies and emerging markets was because of expectations of a rate shock after what the Fed said in May or June. Here you've got yields which are down year to date. So, and it's been very, very country specific. Now one can say that all these countries are very unfinanceable current account deficits. So well, market picks on them, so that won't change anytime soon, etc., etc. But what's your view?
Yeah, so first let me just consider what you're talking about, bond yields. When you look at the US bond market, and you need to look at it slightly longer term, a lot of people would just correlate, well, rates go up and markets should go down and so on and so forth. The US market being pretty advanced market, you find that money essentially moves from one asset class to another. So if you look at it very broadly, when money moves out of bond markets, it goes into equities. When it moves out of equities, it goes into bonds and other assets. And when you look at it that way, then you'll find that the bond market actually topped in June of 2012. It was falling for most of the 1.5 years, and for that entire period the US stock markets were going up. So what you're seeing right now is US stock markets fell in the first month of 2014, and the bond markets actually went up, so which is why you're seeing yields go down. Now that does not change the long-term trend of US yields, which I think should be still on the way up, but because you have a sell-off in equities, you do have a bounce back coming in bonds. So that is more a near-term correlation versus what the longer-term trend is. Second, when you're looking at domestic data, you've seen the Indian stock market move up even in the face of slowing growth.
Rohit, but that's a convenient sort of argument to fit your hypothesis.
No, it's not convenient. That's the trend that has been around. If you just look back at US bond markets, they've gone up and down against the US equities for most of the last 10 years. It's not something that's happened only in the last 6 months. So for 10 years, if you look at a broader data, you will find that bond markets are essentially going up when US equities are falling, and they're falling when they're going up. But the trends can be very different, because the medium-term trend can be up or down for both at points of time. But while one market is moving one way, typically money moves out and goes into the other market. That's what we've seen again and again.
Right. Okay. So you're saying that the trend is up. Yields will go up, right? So focus on that.
No, I'm saying longer term US yields will still go up, but that might not happen while the US stock market is still selling off, which we've seen for most of January. If that sell-off continues in the next couple of weeks, US yields might still further come down from 2.6% where the 10-year yield is. It might even come down to 2.4 or 2.3. But once the US stock market selling is done and you see some kind of a bounce back maybe in March, then I would expect that US yields again start shooting up. They will come back to 3%, maybe go above 3%.
Okay. The other, you got the ISM factory number, right, out of the US, nationwide number which disappointed. It's going to raise another important issue. Continuing disappointing macro data, how does the Fed react to it? Has the Fed made up its mind to get out of QE regardless of data, or whether policy on QE remains data dependent? So far everybody was saying, well, QE is data dependent, etc. But do you think after the last policy, they've made up their mind to get out of QE regardless. They're at that stage. So one bad jobs report won't alter the course. One episode of emerging market crisis will not change that. They will get out. I mean, that's on track. Would you say that?
I think what he said very clearly is that he's going to continue this path till he gets enough evidence that he should not. So I think, like you said, one data point definitely will not make him change his mind on what the course is. But if data points continue in a particular direction, if you consistently see that more jobs are again being lost, or growth is slowing down quarter after quarter or month after month, then definitely it's possible that they actually stop tapering. But till that point of time, I think they'll probably continue this course.
Okay. All right. Fair enough. So let's just get back to here and now. We discuss some global stuff. So you're saying you can sell the index, immediate 5800 on the Nifty, difficult to take out 6100 on the upside. Are there any specific other strategies which one can adopt? Any other stocks, ideas, options?
I think the weakest sectors that we are seeing are essentially the interest rate sensitives right now, which are giving us an indication that there's still downside, and these are metals, banking and realty. Many other sectors have sold off, which might have downside, but are right now not really showing that much weakness, like auto stocks. I think there's more downside, but they have not really participated so much in this sell-off. You're seeing some kind of pullback or rally happening in defensives like Hindustan Lever. We saw that yesterday. That may continue for some more time. It's possible you get some upside, maybe 610 or a little higher on Hindustan Lever in the very short term. I mean, in terms of short-term trades, that might be one area, but we are still seeing weakness in maybe tech also. So you're not seeing that also coming back as a defensive. So essentially on the sell side, if one is looking at sectors, I think the interest rate sensitive sectors are the ones that are the easier targets.
Rohit, it's a pleasure to chat with you. Thanks very much for coming on and listening to your views. Thank you. Rohit Srivastava at Sharekhan.
Thanks.
Come the market. Let's just take that quick break.